Good morning, Tim. Welcome back to our daily session on SPX planning and market analysis with Doc. Welcome, Doc.
Thank you. Without further ado, I'll take it away. Okay, so quick comment about yesterday and where we're at, and we'll kind of see where this goes. So yesterday, as I'm sure most of you are aware, CPI came in softer than expected, or the market liked it. I don't really care about that, but whatever it was, it had a positive reaction. And a couple things I want to point out. So what happened when the numbers came out? Was that over here somewhere? What happened when the numbers came out is the unknown. What's the CPI going to be that has volatility priced into it? Volatility is the unknown or expected move, whatever, wide range, becomes known. So in that instant, pretty much instant or pretty close to it, the whole volatility surface shifts. And so then there's that initial hedging response that we see, and we saw that, that quote unquote crazy spike. That doesn't mean there was no grand plot by the wizards. There was no, they're trying to do this to try to do that. That was simply a hedging adjustment. Volatility comes out of the surface gets repriced, and then we can kind of resume to see where the range might be. Now, also, I'm sure most of you remember, but if not, I'll just use VIX 9-day as a default way of showing it. So VIX and the VIX 9-day, whichever VIX metric you want to look at, was somewhere up here yesterday. The vol came out, and so as volatility comes out, deltas decrease, and to whatever extent market makers was short, or market makers was short, they got to buy back the short hedges and readjustment. So this whole readjustment of the vol surface, and then we go into yesterday's price action. Now, I imagine most of you by now have heard about the JPM collar fund. And if you hadn't, you're going to hear about it briefly now. There's stuff about it all over the Twitterverse. So JP Morgan has a collar hedge fund, which basically sells out of the money calls, roughly 3 to 5% out of the money. What dictates it is not how far out of the money the calls are, it's the price of the put spread. It's a collar, it's protective. They buy 5% out of the money put, sell 20% out of the money put for the 3 months away and the month expiration, and they just rotate, no adjustment other than maybe at the end of the day, after market closes, they might adjust a little bit to get the level according to that metric, and that's it. So why that matters is the quarterly, which is the March, is their biggest fund. It's roughly 39, 38, 40,000 contracts. And so, again, why that matters is right now there's 45,000 long puts, or 40,000 rather, 38,000 long puts. We know they're there. It's not a secret, and the whole market knows they're there too, at 55.65. That's a magnet. We came down, we touched it a few times. I'm not going to belabor this point too much. I might belabor it a little bit, because it's a number you need to have if you're trading this stuff, to have emblazoned in your brain. And you see 55.65, touch. We undercut it a few times, but really that's kind of where we've been heading. And so what happens, and this is kind of for you day trader scalper folks, is customer long, market maker short, doesn't matter if it's a put or a call. From a hedging dynamics perspective, market makers hedge in the direction of the move. So if we're heading down, their hedging accelerates the move down. If we're heading up, their hedging accelerates the move up. So those become magnetic. So they become magnetic on the way down. If we undercut, like we did yesterday, they also become magnetic on the way up. We don't have to talk about the math of why, just know that they become magnets. And so we have a 55-65 magnet. That's all you got to know. It's really all you got to know from a kind of naive level scalping point of view. We have a magnet here. We can easily go through the magnet, especially if that causes volatility to increase, just like we did yesterday. 55.50 is a level they've been buying puts at, and they've been every day. I've been noticing the feature 5,500. There seems to be a bunch of puts, 8,000, 5,000. I'm not sure what that's there for. I don't know that anyone expects it to get there. I do know that I occasionally buy a one lot of a debit spread there just to see what happens to that price. And as we're going down, the volatility goes up. I sell it, I make 30 bucks or something. I'm not doing it for the money. I'm doing it to see what happens. But so we've been getting, as we break this 55, 65, 50, the IV, because this is a big level, tends to spike over here. You start to see crazy premiums, and then we revert back, and that's been what's happening. And so let me get back to my presentation about today. What's going on? And Fabio asked me to talk a little bit about OpEx, and I'll kind of mention that a little bit while we're here. So yesterday we had an intraday range of roughly 100 points, roughly 45 on the bottom to 45 on top. Now the options market, based on volatility, was pricing in about 100 and something point, 100 point, 85 point move close to close, but we moved from 5770 to 5600 close to close, 5670. So we moved 30 points. So once again, implied volatility didn't realize. It didn't pay to own the straddle. It paid to sell the straddle. And so eventually volatility should reset. And that's why even in the down days last week, we had spot down and volatility actually went up a little bit, and volatility actually went down a little bit. So volatility is stretched for now. That doesn't mean it can't come back up. That doesn't mean it can't get restretched. Right now, we're heading back toward the 65. If we open near there, I would expect it to break. Maybe test the 50 area, retest the lows. And wherever it goes, down here we have what looks like, just based on the structure, we'll look at that on the website, credit spreads down here. We also have a double bottom down here from last Friday, where I would expect mean reversion back up into this area. I posted my daily plan there, my Twitter thing, if anyone wants to follow it. I don't get paid. I don't do anything. I just do it for fun. I do it for me. And hopefully it helps you too. To the upside, should we get going above 50, 55, 80, 70 is kind of where like the chop zone starts. We get to 5,600. It's going to be hard to get through there. It's not a coincidence that we stalled out there yesterday. And should we get there, then there's a bit of a path back up to 2025. In theory, 5650. So if you do the math, 56.50 and 50.50-ish were kind of the expected move that was baked into the options based on the volatility. And I mean, it looks like we're heading down there now. I don't know if there's news. Oh, we have 8:10. It's 8:10. We have unemployment numbers in PPI, so this could be pre-PPI positioning. There could be tariff tweets. So I'm not really sure what's going on, but that's where we are for now. Okay. I want to switch gears for a second and talk about VIX and the volatility complex. With the caveat, whatever, I'm not a VIXologist. There's a lot more in the weeds stuff on VIX. But from a retail point of view and from just kind of a common sense thing, we know we have this big VIX expiration coming up next week, and we have the SPX monthly options expiration coming up a few days later, and we also happen to have the FOMC day, the day of expiration. So we have a lot of stuff going on in the volatility space, and in the gamma space. Broadly, we can really think of the options market as volatility or as gamma. In a way, they're interchangeable. And that's coming up next week. So this 25, and we're going to look at something else in a minute, is a really important level. And I'm going to tell you why. If we look at the open interest, you can look in your chain and see what's going on here. There's lots of open interest down here in the 20s, 22, whatever. We're not really concerned about with that right now. We're concerned about this core resistance, quote unquote. Now, these are customer long calls. As we head up, market makers hedge in the direction of the move, meaning buying VIX futures, buying volatility, which spills over into the options complex, into the fixed strike volatility, and that spills over to the delta of the options, and we get the kind of cascading effect we've been getting lately. On the other hand, the more we don't get through this, and as time passes by, the whatchamacallit, the options erode, the deltas erode of these out of the money or near the money calls, market makers get to buy back their short hedges. Now, let me just add, this is VIX 30-day. So that's showing us what's going on for April. What really matters from us is the VIX 9-day, which pretty much takes us right to the VIX expiration. And you see it's over 25. This is really what we're looking at, what's being hedged. And so over 25 equals no bueno. On the other hand, if we can get below 25 and start getting down over here in these 20s, then the picture can shift. So one of my theses, if then path dependent, is if we can get a VIX unclenched from VIX expiration, that can loosen things up somewhat. Maybe the FOMC brings a little bit of relief, at least in the vol space. At least, you know, the macro bros can come up with a scenario that we're not going into recession, whatever it is. Then we might be able to get moving. And then after that, with the March options expiration unclench, that could open a path, maybe in the short term, towards 5,700, 5,750. If we can get over there, the picture might change into April. And I have no idea what's going on in April. We can go down to 5,400, 52. We can go back to all-time high. I don't know. The picture is not looking pretty, though. I'll say that. You know, the default is maybe relief rally, bounce, whatever. and then maybe continuation down, and maybe further down into April, the way things look now at this moment. And I'm a permeable, so I can't believe I'm saying that. Okay, let's take a quick look. Let's take a quick look at the volatility space, and then we're going to look at SPX, at the gamma landscape. So, not rocket science. Here's the expiration for VIX, all expiries. And we see 20 is an iron wall. 20 is the new 16. 16 was the new 12. Get used to it. If we can go below 20 down to 18, that would relieve things a lot. I don't know if that's happening even after expiration, but I'll take below 20, and then there's stuff at 22. We got some puts here. So I'm guessing market participants are betting for a VIX reversion into this 20 area. And so we see the overlap of the puts and the calls in some decent size. Those are possible inversion levels where the deltas and the gammas on one side, let's just say the calls, if we go below it, get lower, the puts get higher, and that's where we get those flip points. Looking at it from a net gamma point of view, you can see real clearly 25 is the number. Over 25, market makers have to start hedging. Remember, we almost got to 30. We were 29.64 or something a few days ago. And even though we made a lower low, VIX didn't make a lower high. And so, to the extent that this can decay, that's kind of the hope for a rally in the vol space that I'm trying to hang my hat onto. Not saying it's going to materialize. I mean, the other side of the story is kind of easier. VIX stays elevated. We're put dominated, loaded in puts. We had that 55.65 level that we've retested, that we broke and managed to reclaim a few times. Should we get trapped below there? There's lots of open interest at 5,500 and lower. And that's the bear case. The bear case is an easy one to make. I don't have to make that one for you. On top of that, we could throw Trump tweets in there. On top of that, we could throw the liquidity situation. Hedge funds have been degrossing at the highest rate and whatever. There's all kind of numbers out there. Vol controls funds have been selling, and CTAs have been selling. On top of that, we're in negative gamma. I put out a tweet earlier this morning. I went down the liquidity rabbit hole. So market makers take liquidity out of the market when they're short gamma. They're competing with you. They're buying the same way you're buying. So in a way, they're also momentum traders. But the point is, they're sucking liquidity out. And I have the statistic somewhere. To hedge a half a point move, it's however many billion notional, whatever it is. And long story short, with the liquidity lower the way it is in the market, commitment of traders, depth of book. And what brought me down this rabbit hole actually was I saw on my phone, I saw a notice from my son's IRA. He doesn't really trade, he's gonna buy and hold stuff. It was the margin requirement for futures has been raised for intraday to 25%. Now he doesn't trade futures, I guess it was a blanket thing. The point is, margin requirements are going up. Liquidity is getting sucked out of the system even more because of the volatility. That just makes for sharper moves. So we're fragile. Like I said, the bear case is easy to make. I'm trying to make the bull case. Which as I listen to myself talk, it's kind of strange. short-term bounce. Okay, so here we are for today, and you see loaded we're buried in puts. We're buried in puts. There's really no other way to say it. There's puts above us. In my little note, I have, we have in the money puts. We have puts all the way up at 56.60, whatever it is. We have puts at 5600, probably straddles. It probably sold 5600 puts and calls at some point the other day, whatever it was. Probably got a couple $100 for it, and then if we end up somewhere near here, it's a winner. And so here's what we got today: 5600. There are those puts, and so unfortunately, your path up today is defined by a path with puts, not calls, as is your path down. Now, the 56, 55, 65 doesn't show up here because they're not in today's expiration, but clearly they need to be hedged and they have a lot of impact. Here's our stall area. Should we go down? And that's really kind of the situation. In a way, it's kind of simple. And now I'll talk a little bit about the VIX expiration, about OPEX. So here's whoops, I can't get it on the screen. Okay, here's the options expiration for the March monthly, and you can see 5700, 5710 and lower, we're just buried in puts. And so this needs to clear out somewhat, and this will go away. This will be gone. So whatever shorts the market makers have for this stuff, and do yourself a favor, look if you're thinking about how this might inflect that day, look around the 20 delta puts and calls and the 80 delta puts and calls and higher to the 30. Those are going to be what's most affected by the hedging. Look at the volume there and see where the balance of power goes. More on that next week. But clearly, there's more puts and calls wherever that's going to be, 5,500 ish. We're going to guess 54.75. I noticed there was a lot of stuff at 54.75. Me and Fabio were brainstorming before, and so should we stay over there? This could unpin a little bit. There we have the 55.65 JPM puts that are magnetic on the downside. However, should we stay above? Should volatility recede a little bit after the FOMC? Could the president, in all due respect, keep his mouth shut for a couple days? We have April 1st tariff deadline. Let's not talk about it for a week. And the debt ceiling clears itself up. That's my projected path for a short-term bounce, and then we see where we are. Now, if we look here in April, should we get over 5,700? Remember the 200 MA was 57 and a quarter. I think I looked before, it was 57.37 on my software. Maybe it's a little higher, a little lower. Basically, should we get above this area, we get above the MA. This might be some reflexive buying. So, that's what we need to see. Okay. We have numbers in 4 minutes. Let me switch back to a chart. Oh, yeah. While we're here, let's take a look at VVIX. VVIX is the volatility of volatility, the demand for VIX calls. And over 100 is a lot. And again, for context, while we're doing it, in case you guys aren't used to looking at this, a line chart's easier to see it than okay. So here we are going back August. Remember the August vol meltdown? Okay, so we got there. That was crazy. So let's discount August for a minute. Let's look at September, where we had a crappy September, if you remember, and it spiked to 130. Now it spiked to 130 this time too. So if we look at the September to remember, we kind of went there and we kind of came down and got a little relief. In December, FOMC, whatever it was, we spiked to here on the volatility of VIX call demand, and we came down. And here we are again to again see some kind of relief. You need the volatility of vol to come down because that's going to influence the delta of those VIX calls. Remember, volatility and delta kind of dance together. That comes down, and that could relieve some of the pressure in the volatility space. A very unprofessional VIX analysis. I'm a retail guy like everybody else, or retail person. I know there's females here, so let me not be sexist. I might get canceled. I'm a retail trader like everybody else. There might be some pros on here too, but so here we are. Let me see. Do we have an update that came in here? Update the script. Now, yeah, one of the new cool features over here is this auto populate intraday update thing. And so we got this here. I got to figure out how to move these over. I won't do that on your time. I'll do that on my time. It's hard for me to see with this crap here. 55.75 is where we are. While we're waiting for the numbers, if you'll indulge me. How the heck do I move these things? Table position bottom. Text label large. I don't know how to move it. Oh, label position right, offset. There we go. Let's just try making it a higher number. Let's see what happens. Trial and error. That's my style. Okay, it didn't do anything. Oh, there we go. It did something. There we go. Now we can see a little bit. And we're at 75, and you know the way I looked at it, the 75.80 is the is where the bulls wanna stay over from a simple TA point of view. 56, 70, 80, wherever it was where we closed on Monday after we hit a new bottom and on Friday and Monday bottomed out, W bottomy kind of thing. Here's Monday, and here we are. And we got 2 minutes to Wapner. That's a joke from Rain Man, if you ever saw the movie. Dustin Hoffman was autistic, and autistics anchor on things. One of the things he anchored on was how many wins it was to Judge Wapner, whatever that court show was. Any comments or questions or whatever while we're here? While we're waiting the last minute, let's take a quick look. Apple in the crapper broke 220, 200 round number, wouldn't shock me. AMD trying to get respectable over 100. Let's look at NVIDIA, the kind of canary in the coal mine, so to speak. NVIDIA and the semis had a decent day yesterday, and they're holding on to their gains. So all things being equal, we can say that that's positive. I had mentioned last week that they were buying the 113 calls for March expiry when we were down at 108, 109. I followed. I bought them in paper hands. I sold them yesterday when we were at 116 or something. I bought a debit spread, so both sides were profitable. I like it when that happens. Not always. Once in a while, you get lucky. So we see, just trying to get a quick feel for what's going on in the market. Biotech, XBI, kind of hanging in its range. Oh, let's look at Bitcoin. Bitcoin stabilizing. So there's signs of stability wherever we kind of want to look. Yesterday, we know the momentum, the Mag 7 outperformed. Let's get back to the mothership. $831. I don't see a huge reaction. I mean, it would be nice to see 5,600. But the reaction is at least saying that, well, nobody is reading into the tea leaves one way or another, which is fine. Back to where we were.
Yeah, I think, Doc, we spiked to 5,600, but then came all the way down.
Oh, did we? Okay, yeah, there it is. Okay, yeah, I have a 65-minute. No wonder I can't see anything. Yeah, look at that. And again, that's that same thing I talked about. The unknown becomes known. The volatility comes out of the surface. Market makers adjudge their hedging. We go up to 5,600 resistance level, where market makers are going to have to hedge against it anyway. We get slammed back down, and here we are at this, betwixt and between. Okay, I got a little too ambitious there with that. Let's see how that does. All right, that's not bad. There you go. And so we're trying to find a range here. Given the way we've been trading, a couple days of consolidation, range trading instead of trend trading would be healthy for the market as well. Oh, Jacob asked, do I go live every morning? No, I go live Tuesday and Thursday on Twitter, and I go live Monday, Wednesday, Friday in the Discord at MenthorQ for the premium members, for like the pro, I don't know, whatever the level subscription is. I'm not really involved in the business end of all that. I just kind of have a big mouth and like to talk and like to help people to the extent that it helps people. Hopefully it does.
Yeah, absolutely. And yeah, the session you do, Doc, are awesome. And we also have other live session throughout the week. So if you are interested,
Right.
I just sent the link. So we have Tim that does macro. We have Dan that does advanced options. We're going to start with volatility with Ryan. We do also some live trading occasionally. So yeah, just subscribe to YouTube, and you can follow all the live session here. They are posted on YouTube.
And that's one of the things I like. I mean, some of you may know me from Twitter or from wherever, I'm not sure. But one of the things is I like having people as resources. It takes a village, the web of internet connectivity and all that. I don't know everything by a long shot, but one thing I'm pretty good at is synthesizing and asking people. I'm nosy. And so if something comes out with a number, I got Tim right there, the macro bro. I send him all the time, Tim, what does this mean? Does this mean I should worry about it or not? If I'm looking at options at a calendar spread or something fancy, if I'm not sure, Dan is real good at that stuff. I got Dan right there. And if I have some higher order question about market making, whatever, which I haven't taken advantage of, but Ryan's available. So there's resources there. We got Marco, who was like a professional oil trader of some sort. Or come on, So there's resources, which is good to have. I I'll be first to admit that I use my resources all the time. A lot of what you see me say is synthesized through the lens of stuff I've read, stuff people have said. Some of it I agree with, some of it I don't. Some of it I synthesize, put my own spin on it. Um, I suggest you guys do that too. It's just kind of the way I find this thing works. So, on one last thing, and then I'll get off this kick. Um, I've heard people say something like, "Oh, there's too much to master. I don't understand everything, so I'm not going to do anything," or get overwhelmed. The truth is, from a learning theory point of view, I'm a psychologist, so I'm going to go into learning theory for a second. 101. It's called scaffolding. You build a cognitive structure. You have a little bit of understanding, and then you can use it somewhat, and you have to kind of think about it, and then you kind of scaffold up to another level of understanding, and then you kind of recede back down to the previous level, and then kind of like trading, then your resistance becomes support, and over time you begin to have build just a concrete knowledge base as well as an intuitive way of integrating it, as long as you keep working at it. If not, if you don't use it, you lose it. That's the other side of that coin. So anyway, that's my pitch for that. Any other questions before we're done?
No questions so far. So thank you so much, Doc. As always, guys, just follow us on our YouTube channel. I pasted the link in the comments. We're going to have some really exciting lives. Next week, we're going to be a bit light, but following week, we're coming back and we're going to have a session with Ryan. Doc is going to be back. And we're going to have a lot of new things coming as well. So don't miss those. And for those who want to join us and look at all the data that Doc showed you and that we have within our dashboard, just look at MenthorQ.com and check out our integration, our product. And then we're going to be back with you, Doc, in a week or so. Not next week, but the following week we'll be back with the standard on Wednesday.
Okay, my pleasure. You're welcome, Wolf. Okay, everybody, trade safe.